Hi everyone, welcome back to Wealth Takeoff. Today we are diving into an essential topic for any investor or trader: stock market order types. Understanding order types is key to executing trades effectively and protecting your investments. By the end of this video, you'll have a solid grasp of the different order types and when to use them. Let's get started. What are stock market order types? When you buy or sell a stock, you're placing an order with your broker. The type of order you choose determines how and when your trade will be executed. The four most common types we'll cover today are market order, limit order, stop loss order, and stop limit order. We'll cover buy and sell transactions for each of these order types. So, why do these order types exist? Each order type serves a unique purpose to meet different trading goals. Whether you want fast execution, precise price control, or a way to manage risk, these tools help investors navigate the complexities of the market. Let's break down each one of them. Let's start with the market order. A market order is the simplest and fastest way to buy or sell a stock. When you place a market order, you're telling your broker to execute the trade immediately at the current market price. So, when will you use a market order? When speed is your priority and you're okay with minor price variations, market orders are ideal. So, what are the pros of the market order type? The pros are quick execution and it's ideal for stocks which have small price spreads. That is, the bid ask spread is small. The cons are there's no price control, so you might pay more than expected in volatile markets. Let's say you wanted to buy 50 shares of Tesla. If the stock is trading at $220, a market order will buy it at the best available price, which may be 220 or slightly higher or lower depending on market fluctuations. Next, let's look at the limit order. A limit order lets you set the maximum price you're willing to pay for a stock or the minimum price you're willing to sell it for. The trade will only execute if the stock reaches your specified price or better. So, why use a limit order? Limit orders are great when you want control over the price and you can wait for favorable conditions. Let's look at the pros of the limit order. The pros are that you have full control over the price. The cons are there's no guarantee that your order will execute if the stock doesn't hit your price. Let's look at a buy limit order example. Let's say you want to buy Apple stock, which is currently trading at 350, but you want to buy it only if it drops to 250. So you place a buy limit order at 250, which is the maximum price you're willing to buy Apple shares for. The order will only execute when the stock price hits 250 or lower. Now let's look at a sell limit order example. Let's say you own Microsoft stock, which is currently trading at 200, but you want to sell the stock at 350. So you set a sell limit order at $350, and that's the minimum you're willing to sell for. And this order will execute only when the stock reaches 350 or higher. Next, let's look at the stop loss order. A stop loss order is designed to limit your losses or secure a better entry point by automatically executing a trade when the stock reaches a specific price. So, when will you use a stop loss order? When you want to manage your risk automatically by capping losses, or when you want to ensure that you don't miss a breakout opportunity, you'll go in for a stop loss order. So, the pros of the stop loss order are it helps you manage risk by capping potential losses or locking in your momentum. But the cons are in a highly volatile market, the stock can execute at a price which is less favorable than your stop price. So let's look at as an example. So this is an example of a buy stop loss order. You're watching Apple stock which is currently trading at $250. You want to buy only if the price shows upward momentum. So you set a buy stop loss order at $300. And if the stock rises to 300, your order will execute at the next available price. So this triggers a market buy order when the stop is reached. Now let's look at the other example of a sell stop loss order. So let's say you bought Microsoft at $350 and you want to protect against major losses. So you then set a sell stop loss order at $300. If the stock falls to $300, your order will automatically sell the shares at the next available market price. Now let's look at the next type of order type, which is the stop limit order. A stop limit order combines the feature of a stop loss and a limit order. Once the stock hits the stop price, the order becomes a limit order, executing only at your specified limit price or better. So when do you use a stop limit order? When you want precise control over execution and still needs to manage your risk. Stop limit orders are ideal. So the pros of the stop limit order are you get more control over the execution price, but the cons are the trade may not execute if the price moves too quickly. So let's look at a buy stop limit order example. Let's say you're interested in buying Apple stock, which is currently trading at $250. But you want to buy it only if it starts rising above a certain level at a specific price. So you set a stop price at $300, which is your trigger price, and you set a limit price at $350, which is the highest price you're willing to pay. So if Apple stock rises to 300, your buy stop limit order activates but will only execute if the price stays at $350 or below. Now let's look at the sell stop limit order example. Let's say you own shares of Microsoft which are trading at $350. To protect your profits, you set a stop price at 300 and a limit price at 250. If the stock drops to 300, a sell limit order activates, but it will only execute if the price remains at $250 or higher. So to sum up the key takeaways of the order types, market orders are fast but lack price control. Limit orders give you price control but there's no guarantee of execution. Stop loss orders help limit your losses or capture momentum, but they might execute at unexpected prices, especially in volatile markets. Stop limit orders offer price control but may not execute at all in fast moving markets. These different order types exist because every trader or investor has unique goals. Some prioritize speed, others value price precision, and others may need tools to manage risk. Choosing the right order type helps you to execute your strategy effectively. If you found this video helpful, hit that like button and subscribe to Wealth Takeoff for more investing insights. Don't forget to comment below with your favorite order type or with any questions that you may have. Thanks for watching and I'll see you in the next video. Happy investing.